So exactly what an IPO is. First, you can read the definition of IPO. So in a nutshell, selling the shares of a company to the public for the very first time to raise money in order to expand the company or any other reason is known as initial public offering or IPO. Now I have mentioned first time. It's first time because if the company is already listed on stock market and issues more shares, then it is called follow-on public offer. But if the company is issuing shares for the very first time, then it's an IPO. Now let me talk about the process of IPO. The process of going public is quite time consuming. So first of all, the company doesn't know all these stock market rules and the functions and various other procedures as to how to get listed and what are exchange requirements and stuff like that. So they first of all go to investment banks because they are the experts in this type of business and they know how to deal with IPOs because this is their business and they know a great deal about it. So they do all the paperwork, formalities and all that similar stuff that is required when a company goes public. But the most important reason for approaching an investment bank for an IPO is they take the risk of underwriting. And as you are a beginner, so I assume you don't know what underwriting means. So let me explain that. It's quite simple. Underwriting basically means taking the risk of selling the shares of a company to public by buying those shares. So if a company wants to issue shares to public, it doesn't do it directly. Instead, it goes to an investment bank and the bank buys all those shares that the company wants to sell at a fixed price on which both the parties have agreed upon. And when the bank buys the shares, it gives the money to the company, which is the total amount of shares bought. Then the banks make sure that it sells the securities that it has bought from the company to the public in stock market. Now, as the investment bank is taking the risk here of buying the shares of a company, as there is no guarantee that the bank would be able to sell all those shares to the public. Also, even if the bank manages to sell the shares, there is still no guarantee that the banks would be able to sell the shares at a price equal to or more than what they have paid for the shares. So for taking the risk, they charge a fees, typically called commission. They take commission in proportion to the deal value. That is, if the company wants to sell $100 million of shares, total deal value would be $100 million. Usually, companies for big IPOs charge a fee of 3 to 5% of the total deal value. Some deals are worth hundreds of millions of dollars, but some goes into even billions. The largest IPO ever was in 2014 of e-commerce giant Alibaba, where the company raised a whopping $25 billion. And the IPO was so big that there wasn't any single investment bank to handle this, but 6 banks managed this monstrous IPO. And these banks were Citigroup, Credit Suisse, Deutsche Bank, Goldman Sachs, JP Morgan and Morgan Stanley. Now, underwriters, when helping a company go public, also do some strict examination of the company, whether the company is good enough to take a bet upon or not. I mean, these bankers are not stupid. If they are risking their money, then they have their reasons also. Some factors after meeting which investment bankers takes the risk of helping companies go public are sound business history and financial statements, innovative product, strong player in the industry, financial audit of the companies, and minimum annual revenue and earnings. So these were some criteria which investment banks looks after. And finally, when the deal has been finalized between the bank and the company and some other formalities and paperwork has been done, then the bank files a registration statement, which means filing the company with the concerned regulating authority with various documents which are required to be submitted by the regulatory agency. Regulating agencies differ from country to country, which I told you previously, and in USA it's SEC. So these documents are about company's history and tells about various things about the company, like what business the company is in, what are the potential risk factors for investing in the company, the ways it will use the money raised in the IPO, current ownership of the company, management background, etc. Now the SEC takes time to take a deep look at these statements so as to figure out all the necessary information has been disclosed or not. Now, during the time the SEC is looking at the documents, companies issue a red herring prospectus to the prospective investors. And a prospectus is basically a document which explains about the company's business in detail, its past history, financial statement, and other important information about the issue. Actually, this is the first version of the prospectus and is known as red herring because the first page has a red warning that the prospectus is not final and is subject to change because the documents are still with SEC and there can be some changes. Actually, in short, the registration statement is itself a red herring prospectus once it has been filed with SEC. This is usually presented to prospective investors so that they can analyze the company and make the decision whether to invest in the company or not. Before the date on which the company should go public, the corporations go on a roadshow. And a roadshow is basically a typical promotion event where the company goes from one place to another to attract big institutional investors. The management shows presentations to the investors in order to induce them to invest in the IPO. And after the SEC looks after all the submitted documents, and if there are some changes, then after the company amends those changes, the SEC then gives a green signal to the company and assigns them the date on which the company will go public. The promotions of the company and expected demand of these shares determines the pricing of the company, which is shown in the final prospectus. And then the company issues final prospectus to the public so as to attract more investors. And finally, on the offering date assigned by the SEC, the companies go public. And that's basically all about the IPO and the process about how the companies go public.